This is our Forex blog for March 22nd, 2013, and there's literally hundreds of ways to trade Forex using our software. I like to go over in the Forex blog what I consider the most effective, the easiest, the most profitable, and like I said, the easiest to learn for new traders. Nothing is easier, in my opinion, than just simply using our currency indexes. This is a tool I created, and as far as I've looked around on the internet, doesn't exist anywhere else. These are actually charts of each individual currency pair. We compare the euro, every single euro pair, euro dollar, euro yen, euro CAD, euro pound, euro Australian, euro New Zealand, euro Swiss, and we actually create a chart with it. And we also show you the point of control, which is the yellow line in the middle. This is where most traders have euro positions in all the pairs yesterday. Previous day's low, previous day's high of the euro index, hourly moving average in gray, and 15-minute moving average in green. You can, at a quick glance, and these are all the 8 pairs, but parts of my blog today I'll just show the 4 main ones, also with our FX trend intensity. This statistically compares each currency using our statistical models. Levels that hit the 40 level typically continue. Levels that hit the 80 level virtually always continue. Like you can see here, the yen, it shot up. After a little bit of pullback, the trend continued up. Extreme weakness, that trend continued down, but let's just showcase some of the easiest ways of trading with this. And in my opinion, one of the easiest ways of trading with this is to do just a simple quick analysis of each currency. Is it above or below the point of control? If underneath, it's likely to trend down. Is it above or below the hourly moving average of the index, which is the gray one? If below, it's likely to trend down. And sometimes currencies are in between the hourly and the point of control. And in those instances, you tend to get choppy trading. So not only does it help you find which currencies to trade, it also lets you know that frequently when they're in between there, you're going to have very choppy sideways price action. And so you don't waste your time, you don't have unnecessary losses. So looking at these currencies, you can see that the dollar is likely to go down because it's underneath the point of control, the yellow line, the average price that pretty much most traders have in all the dollar pairs. And you can see the Australian broke from below to above the hourly and the point of control right here. Didn't last very long. Not all trades are guaranteed to find trends that just continue. You can see here the CAD is underneath the point of control. It breaks from above to below the hourly, goes sideways and breaks down. That trend lasts for a couple hours. You can see the yen, it's above the point of control. It's kind of going sideways here around the hourly. There's really not much movement. And at 1 o'clock right here, breaks out. So, you know, when this CAD gets really weak here at 2, and when one of them's strong, the other one's going sideways, you can trade one versus the other. If one's getting stronger and one's going sideways, and the trend is down, like the CAD yen, you can sell the CAD yen at 1. But when the CAD breaks down across all of its pairs, it's moving down virtually against every single pair, and the other one's going up or is showing signs of strength, you know, you're going to have a lot bigger movement. When one's going down and one's going up, typically your profit from a successful trade is going to be 20 to 50 pips, sometimes 100, 150 pips. When one currency is going down and the other one's up, I mean, one's going sideways and the other one's going up or down, you're going to make 5 to 20 pips typically. So let's take a look at this CAD yen here after 1. And remember, the 2 o'clock time is even better. So here you see the CAD yen, and like I said, 1 o'clock, the yen broke out to the upside. So this currency, you can see it's clearly underneath its hourly moving average. The perfect oscillator, which for many reasons I call it perfect, watch some of our other blog videos to kind of get a feel for that. You can see it's kind of just going sideways with very low volatility. Anytime a currency is underneath its hourly moving average, it's more likely to go down. And you can see this one falls about 40 pips here. And after 2 o'clock, the CAD kind of breaks down, and the yen is already trending up. So you're basically looking for sells. typically I will look for a 15 to 25 pip pullback. So this barely meets my criteria. And one of the methods that I use is when I see a currency that's weak, I will, if I see the perfect oscillator go up and hit the Bollinger Bands at the high end right here, it's a great place to sell. And you can see it gave that sell signal right here. And the market is kind of going sideways. You wait for it to break down underneath the lows. I would have probably got out maybe within 20 or 30 minutes when it really never fell, and then got short again here and caught the next big move to the downside. Now, since I have this chart up here, let me just show you why I think the perfect oscillator is one of the better tools. When price goes to or underneath the 80 level, typically it's going to stall or reverse, and you can see that happen right around here. The market went sideways for 2 hours, came down right here. Price got a little bit of a bounce, came down again right there. Notice the 80 level, and then it also broke down underneath here. And guess what? The price, bounced again. On the upside, this level right here got hit. The market went sideways for an hour and a half, kind of pulled back 10 pips. If you got short right there and it never fell away, and then price hits the lower band right here and doesn't go through it, and you might want to get out of your trade. But at least you don't have a loss. Anytime these oscillators get hit at an extreme level and you don't get a 15 to 30 pip move out of them, it's typically going to go the other way. So, and you can see after 6 o'clock right here, we bring up all the currencies. After 6 o'clock, the yen is no longer strong. It broke out above the previous day's high and then fell back into the range here, and you can just simply draw trend lines on the chart, and when price is trending up and breaks the trend line, guess what? The move's over. It's one of the best ways of using this tool. In fact, you can kind of see that here with the Swiss. The uptrend kind of was over for about an hour, then it went up one more time and failed. You also have a nice little trend line break right here. Trend line breaks are one of the highest probability methods for using this. You can see here it nailed the end of the move and it went up for the next 5 hours. So not to get sidetracked with going over trend lines, I just want to illustrate some high probability trades. Anytime a currency goes sideways for many hours and then breaks down, it's a pretty high probability trade. So you can see at 5:30 here, the New Zealand's likely to go down. Which one is showing signs of it going up at 5:30, or it's either going up or it's showing signs that it's about to, or it's likely to. Well, the Swiss came down and found support at the previous day's low here and here. It also right around 5:30 breaks out of this trend line right here. So pretty high probability New Zealand Swiss sell. New Zealand's likely to go down. The Swiss is likely to go up. It's really that simple. Let's put the New Zealand Swiss on here. We're looking to sell this at 5:30. And of course you can see, notice first of all the perfect oscillator nailed that high there. It also was in an extreme reading right here. The price never went up. But that being said, it wasn't able to go above and make a higher high from these levels today and from that level yesterday. It also, you can see, kind of broke out through here, and especially confirmed when it broke out through the low. This fell 10, 20, 30 or so pips. And of course you can also draw the fibs on the chart. When one currency is going up and the other one's going down, typically if you draw your fibs on there, the fib target is a great place to get out of your trade, especially when you have two different methods that are both accurate by themselves. Fibonacci profit target's very accurate. Our perfect oscillator tool, very accurate. And when the few percentage of times when the 80 level gets hit and you don't get a move up, that is showing just extreme weakness and the trend's likely to go down. However, I will say that anytime a plus 80 or minus 80 level gets hit and the trend continues, usually the next time it hits this extreme, the market's going to reverse. So this is kind of one of those things where if I was short, I would bail out of this trade and flip and go long to try to catch a move to the upside. But you can see at 5:30, our indexes were telling you to sell this, and that was right around here. You got in as early as possible. Traders that don't have our tools wouldn't have known to look at the New Zealand Swiss. They might not have even been watching it to catch this move here, and they would have missed a, you know, in this case, a 10, 20, 30 or pip, 30 or so pips. You can spot all kinds of patterns with this. You know, double tops, double bottoms, 1, 2, 3 lows. Here we have the CAD breaking down, rallies up, comes down, it has a higher low than before. It's a pretty high probability trade. It's likely to work its way back up to the hourly previous day's low. I wouldn't have it at that time at 6:30 bet it would go back above the previous day's range. But 1, 2, 3 patterns tend to be very successful. Trend lines, fib areas, double tops, double bottoms, and so forth. Or you know, pretty much all patterns that work on regular charts. You have a kind of a head and shoulders pattern here with the two neckline and the heads. And so when it breaks out of this area right here, very high probability pattern for the yen to go up. And you can see it went up for about 40 minutes, coming up to 1140. So what currency was weak at 1140 or likely to go down at 1140? Well, you have the exact opposite pattern here in the Swiss. Notice the head and the neckline. So the Swiss yen makes a great one to be selling. Unfortunately, 1140, the euro is already going down. The dollar pretty much was already near the lower containment band. So I prefer to find currencies that are a little, you know, more likely to just start a move, and so there's more room for it to kind of go. So I would take a look at 1140, the Swiss yen. So that's just my own personal preference. I like to get in trades that are more likely to give me 20, 30 pips and make it worth the risk. Because not all trades are going to work. So here's 1140. You also have a head and shoulders pattern on this. And so basically looking at that chart, I would have been short right here, you know, a few pips above that actually, maybe at 160, let's just say. We'll round down to 160. The hourly moving average makes a good profit target. You also have, and so even if you got out here at the hourly, missed those extra 15 pips here, you made about 35, 40 pips. And the fib target also is an excellent place to be looking to get out. So if you did hang on past the 1.382, typically the 1.618 is, you know, the end of the move. And if you notice, our perfect oscillator is showing extreme, you know, oversold levels here, and it's likely to bounce, and it does. It goes up 40 pips from there. Again, another reason why I call it the perfect oscillator. So let me just end today's Forex blog by saying, if you use tick charts or range charts, you can improve the accuracy even more. And I typically trade with range charts, not 5-minute charts, but I just, rather than wait for the data to load, I like to go over in our blog video, just showing 5-minute charts. Even something as simple as a 5-minute chart can help you, you know, spot these excellent trades. So here's the Swiss yen. Remember, at 1140, we're looking for sells. Coming up to it right here, it breaks down, and using a range chart, you can just kind of, these are 5 pips per bar. You can kind of just spot and kind of eyeball the trend line over the level here. And as it goes farther and farther down, you know, I would move my stop above here, and I would have probably exited a little bit around 30 level. And we could have, if you wanted to wait for that low to be hit, you could have been short this around 60, out at 30. Nice 30 pip move. So let's, actually I would like to go back and showcase the currencies combining both. One is the actual index, the other is our statistical intensity tool, which we have, you know, been working on and developing for the last 6 years. We've had these for 6 years. We call them our currency meter. It's awesome at helping people find which currencies are strongest and weakest to trade, but it doesn't help you anticipate like the indexes do. In other words, you can't see the previous day's low got broken. Price couldn't break out above the hourly right here. Nice little wedge pattern breakdown here at 10 o'clock. The daily trend's down, the weekly trend's down. The intensity to the downside is significantly higher than the statistical strength when it was trying to go up. So all those tools together really kind of predict with a very high degree of accuracy, in my opinion, at 10 o'clock, the dollar is likely to go down. Here, the euro found support at the previous day's low, which is a sign of strength. And remember, it's chopping around inside between the point of control and the previous day's low. Two resistance above, support below. Once it breaks out right here, it's very strong. You can see it was very strong on the way up. The weakness on the way down was very little. You have this nice little pullback right here. So the euro is very likely to continue up. The dollar is very likely to go down. At 10 o'clock, it doesn't get any better in this. In fact, somebody emailed to me today that they said I thought our software was hard to understand. How can this be any? How can I make this any easier for people? When one currency is very likely to go up and the other one's likely to go down, you want to buy the strong versus the weak, or sell the weak in this case, buy the strong versus the weak. We're looking to, at 10 o'clock, buy the euro dollar. So here's the euro dollar, and you can see just on a simple 5-minute chart right here, coming up to 10 o'clock, we had a nice pullback down. And it's also the fib target. If you drew your fibs off of this, more than likely one of those fib targets is right here. This is a method that I use. I don't go over that much, but when the perfect oscillator, the Bollinger Bands around it get tighter and tighter, it's kind of a squeeze play. This shows when volatility is getting less and less and less, breakouts tend to happen. So 10 o'clock right here, you can see it went from 29.50 up to 3,000. Now your stop would be right underneath the low here, or if you use the range chart, you would have actually had only a 5 to 7 pip stop. But this trade generated 50 pips of profit. And notice again, that the market's gone up too much. It's likely to reverse. And of course, within 5 minutes, it falls. Within 5 minutes, it begins a 20 or 30 pip move down. And also notice the perfect oscillator here. Double top, perfect oscillator, another 20 pip down. I mean, you can pretty much use the indexes, the perfect oscillator, a 5-minute chart, or a range chart, and ride these currencies up, flip and go short, buy the pullback, ride them up, flip and go short when the perfect oscillator tells you to, and ride them back down, and catch more pips than people that just buy and hold.